Andrew Wellington, founder and CIO of Lyrical Asset Management in the US, will explain why their approach to value investing will poke holes in the popular narrative.
Hello, everyone. It's good to see you all, if not virtually. Greetings from New York City, and hope to see you all in person next year in London. My presentation today is going to talk about value investing, which hasn't been the most popular style of investing over the last few years, but that's because a lot of the popular narratives give it a bad reputation, and I'm going to poke a lot of holes in those popular narratives and show you what an opportunity value investing is today. So what are the first popular narratives about value is that it's been terrible for a really long time. And in the US, if you look at how the value index by S&P compares to the overall market index, it seems to back up that perception. For more than a decade, the S&P 500 value index has underperformed the S&P almost every single year, and now by quite a lot. However, as I'll explain a little later, the S&P value index isn't really value investing. If instead you look at value stocks, and by this I mean the cheapest stocks in the market as ranked by PE. Specifically, we take the 1,000 largest stocks and we take the bottom 200, the bottom quintile, the bottom 20%, and look at how they've performed. The cheapest stocks in the market since the financial crisis have actually outperformed quite significantly. That is up until the end of 2017. Now, it is true that these stocks have underperformed for 2 years, starting in 2018. We can see that at the beginning of this year, at the bottom of the COVID panic, value stocks have started to make a recovery. And so one of the popular narratives about value being broken for more than a decade just isn't true. Value worked great for most of the decade following the financial crisis. It's just the last couple of years where value's been out of favor. And this is totally normal. What we just showed is that the S&P 500 index, value index, is not really value investing. And let me explain to you why. If we compare the differences between the S&P 500 value index and what we call the lowest PE quintile, what I showed you that outperformed great from following the financial crisis, there's some important differences. What S&P does in their value index isn't what a lot of people would consider value investing. First of all, they want to take the whole S&P 500 and divide its market cap evenly between its growth index and value index. And because the value companies tend to be smaller, they need a lot more of them. Plus, they take some companies and they split them because they have both value and growth characteristics. And as a result, almost 400 out of 500 stocks in the index are in the value index. So 80% of the companies are in the index. So this is not an index that focuses on the cheapest stocks. It's rather an index that owns almost everything except the most expensive stocks. As a result, and plus because it's cap weighted, it ends up with a very different return profile than just owning the cheapest stocks. This goes back as far as we have data on low PEs, which is about 22 years. And if we look at how the lowest PE stocks have done over that 22-year period, they've done great. They've returned a cumulative 732%, which is 279 percentage points more than the S&P 500. The S&P 500 value, though, in an environment when these value stocks did great, did quite poorly. It only returned 301%, which is 153 percentage points worse than the S&P 500. So between the charts I showed at the beginning and this, it's quite clear that the S&P 500 value doesn't really index, doesn't do a good job of tracking how the cheapest stocks in the market, the value stocks, are doing. And as a result, we like to say, Warren Buffett is famous for being one of the wealthiest men in the world and for being one of the greatest value investors of all time. Warren Buffett has given value a great name. But these indices have probably given value a terrible name, especially over the last several years. Why is the S&P 500 value index so terrible? Well, as I showed you, with 400 stocks, most of the index isn't the cheapest stocks. On the left, you could see that the cheapest stocks only make up about a quarter of the index. The rest of the index comes from things that aren't the cheapest stocks, including some of the most expensive. On the right, we can see that generally the stocks perform as they should. The cheapest do the best, and the most expensive do the worst. The problem is that there's just not a lot of them in the index. The other thing is the index is capitalization weighted, where when we look at the lowest PE stocks in the market, we look at it equal weighted. And cap weighting historically has also been bad for returns. In fact, whether you're the cheapest quintile or the most expensive, cap weighting lowers your returns across the board. Now, it's worse for the cheapest stocks. It hurts the value stocks the most. And because of some of the FANGs and things like that, it hasn't been so bad for the most expensive. Now, you do see when you cap weight, the percent of the index in the cheapest does go from 25% to about 35%, but still there's a pretty significant negative impact on returns by cap weighting. And as a result, we could see how this all adds up. That if you just own the cheapest quintile over this period of time, you had a 19.6 annualized return. Because a lot of the S&P 500 value index isn't in the cheapest and has from a lot of stocks, most of their stocks from more expensive quintiles, that's lowered the index return by 2.3%. And so if you just equal weighted the S&P 500 value, you'd still do okay at 17.3, but they don't, they cap weight it. And that kills another 3.7% of its return and gets you down to 13.6, which has underperformed the overall market over this period of time. This is a long way of saying two things, as I said. The popular narrative that value's been bad for a long time just isn't true. The value index has, but value stocks haven't been. And the other thing is that just to know that the value index is not value investing. You really can't get value investing from an index. It just doesn't exist. It's not how the major index creators have created their indexes. And really the only way to get true value investing, the kind of investing that had delivered those great returns post-financial crisis, is to do it through an active strategy. We take a step back. Why be a value investor? This is the answer. The blue line is if you own the cheapest stocks going back as far as we have, going all the way back to the late 70s, which is when S&P created its value and growth indices. And those are those three lines at the bottom. It's hard to tell them apart because they all kind of have performed the same over this long period of time. Their indices don't really show a lot of style characteristics. On the other hand, if you own the cheapest stocks in the market, you did incredibly well. That's that dark blue line. You've outperformed the market by 450 basis points per annum. Over a 10-year period, on average, you've outperformed cumulatively by 170%, including the good times and the bad. If you held for 10 years, you outperformed the market 94% of the time. If you held for 10 years, you've never had a loss. And these value, the performance of value stocks does go through cycles. We do see dips there. But the average length of an upcycle where value's outperforming is a long 8.3 years. And like this recent period we've just gone through, the average length of a value down cycle is just under 2 years. Value does go through cycles. Real value works, but not all the time. There are short, acute periods of significant underperformance. And we have 60 years of data on value stock performance, and we lay it out here. And as we showed you on the previous page, in the bottom right corner, overall, over 60 years, value stocks have outperformed the S&P 500 by 450 basis points per year. It's pretty crazy when you compound that over that 60-year period. You get nearly 10 times or more than 10 times the return. Value stocks up almost 400,000% versus just 35,000% for the S&P. But it doesn't work all the time. Historically, about once a decade, you get a period of about 2 years where value stocks are out of favor. And starting in 2018, we had one of those periods. But there's really nothing about it that's different than what we've seen in the past. It's on the long side at just over 2 years, but The tech bubble was about the same duration. In the early 70s, when we had the OPEC oil crisis, it was about the same duration. So this one isn't any longer than what we've seen. We go through March 20th because it does appear that that's where value stocks have bottomed, at least for now. In terms of performance annualized, over this 2 years, value stocks have underperformed by about 19%. That's in line with other down cycles. It's not more severe. The tech bubble at 25% was a lot more severe. So as we look at this, there really is nothing new and different about the underperformance of value stocks in the 2 years from 2018 on. This just appears to be just another value cycle. The popular narratives that something's broken, that it's disruption or low rates, or it just doesn't seem to hold up, that there's really anything different this time. The other thing to keep in mind is, as we look at how these cycles are connected to each other, does the strength of a good cycle lead to a bad cycle, or does a strength of a bad cycle lead to a particularly good cycle? We see no real connection in how good an upcycle is compared to the previous down cycle. So what we did here is, if you go back to this page, we look at how good was the cumulative return in the upcycle, and then how did value stocks do in the next down cycle. So how did 264 lead into minus 20? And there really isn't a strong connection. The worst down cycle was the tech bubble in the 90s, and that followed a mediocre upcycle. The least severe down cycle was the global financial crisis in the late 2000s. And that followed the best upcycle we ever had, which came after the tech bubble. And then we have the past decade, and this is one of the reasons why the narrative might be so negative on value stocks these days. We had a rather weak upcycle in the first decade of the 2000s. The second decade, the 2010s. And then it led into, we had that weak upcycle, it led into one of the worst down cycles. So this combination hasn't been as strong as any of the other decades. The good news is, while there isn't a connection between upcycles and then the next down cycle, there's a very strong connection historically between how strong an upcycle is after a down cycle. So again, we showed after the rather modest underperformance of value in the tech bubble, in the financial crisis, we had a weak upcycle. But after the worst down cycle we ever had in the tech bubble, we had the strongest upcycle. The down cycle we just had in the last 2 years is the second worst one we have in history, which bodes very well for the kind of upcycle we should expect to have over the next decade. This is also backed up by just how cheap value stocks are today versus the average stock in the market. This chart shows the PEs of the cheapest stocks in the market compared to the PEs of the average stock in the market, as well as what the spread is between these two lines. And we could see back on March 10th of 2000, this valuation spread peaked at 165%, where in normal times we typically see this more like 65% or 55%. The financial crisis, we also saw a peak, but nowhere near as big. It only got to 109%. And then on March 18th, at the peak of the coronavirus fears in the market, the value spread got to 136%, almost as wide as the tech bubble, far wider than the financial crisis. Now again, we've had a strong rebound since that March 18th bottom, but still the valuation spread today is 112%, which is wider than it was at the absolute peak of the financial crisis. And the peak of this valuation spread is a pretty good indicator of how much outperformance potential, how tightly coiled the spring is for value stocks to perform. This isn't our work, but just to solidify the point, AQR, which does fine quantitative research, has really broken down a lot of the other myths around and popular narratives around value investing. That price to book doesn't work anymore, that it's about the technology today and disruption. So on the left, what they did is they looked at not just price to book, but all kinds of value measures: price to earnings forward, price to earnings trailing, price to sales, price to book. By every measure, they see that the valuation spread today is the widest or near the widest it's been in history. They've also done a lot of work to look at the whole universe, or try it what happens when you get rid of tech, or what happens when you get rid of the biggest mega caps or the most expensive stocks. Is there something different this time? And when they go through all these scenarios, they keep finding out too, on the right side, that by every measure and by every adjustment, the valuation spreads today are about or are the widest in their history. So all these popular narratives that are being proposed for why it's different this time just don't hold up under careful scrutiny and analysis. Now, value stocks, buying the cheapest stocks in the market has been very successful. The problem is it's very difficult for investors to follow that. A lot of the stocks that are in the cheapest part of the market are low quality. They're bad businesses. They often have problems. The market tends to overdo things. It loves the good businesses too much and puts too high a multiple on them. And they are good businesses. They're just not deserving of that multiple. And over time, they tend to outgrow the market, but the multiple shrinks. And as a result, they underperform. Value stocks are the opposite. Over time, they tend to be not as good as the market. They don't grow as fast, but the market puts too low a multiple on it. And even though the earnings don't go through as good as the rest of the market, their multiples expand for being too low, and they end up outperforming. When you're a bottom-up investor and you sift through the cheapest stocks in the market, you find that they're not all bad businesses. Yes, most of them are, but not all of them. And as an active manager, you have an opportunity to sift through those cheapest stocks and find those exceptions that aren't the bad businesses. And so at our firm, while we do look for value, and we want to look for value because value drives so much outperformance, we filter the cheapest stocks and look for those that are also good businesses and those that are easy to analyze and easy to understand. And as a result, as I mentioned, the cheapest stocks in the market aren't often the best businesses. In fact, more often, they're the worst businesses. If we look on the right, this is the historical earnings growth of various indices and the value stocks we own. And if we look near the bottom over here, we see that the S&P 500 value and the cheapest quintile have much lower earnings growth than the overall market. But as I said, there's exceptions in there. And you can build a value portfolio that does have growth as good, if not better, than the S&P 500. It's not easy. You have to be really picky and selective. There aren't 200 stocks like that. There's not even 50 most of the time. But you can find 30 or 40 stocks that have this kind of characteristic. And if you look on the left at the value spreads, the cheapest quintile, while it doesn't grow, it is a whole lot cheaper. The S&P 500 value, while it doesn't grow because of its poor construction, isn't even cheap at all at 16.6 times. And today, with earnings depressed because of COVID, the S&P 500 is at a decade high 21 times. Our multiple is about the same as the cheapest quintile. It's a little bit lower. So we're not sacrificing any valuation, but through pickiness and selectivity, you don't have to just own the cheapest stocks. You can find better results. And if you can own things that are just as cheap and grow faster, then you should be hopefully able to generate even better return than just owning the cheapest stocks in the market. It's a little more tangible to look at specific companies. And so here's a couple that we like to highlight. That is how we get to these great metrics. So here's one example. It's a company in the US called Quanta Services. And they're listed as an engineering and construction company, which sounds like a very cyclical business. But that's really a poor label to apply to them. There really isn't a good label. But what they do is they fix the power lines for utility companies in America. Most utility companies don't have enough people to fix their power lines when a storm comes through, or they haven't been able to retain their labor force, and they need the help of an outside firm like Quanta to maintain their power lines. So most of their work is maintenance related. 80 to 85% of their sales are very stable. And it's a very fragmented industry, so they've been able to grow much faster than their end market. And we were able to find this stock at 10.5 times earnings when the value index was 13 and the market was closer to 16. And yet, if we look at the bottom at what kind of earnings growth Quanta's been able to generate, it's way, way faster than the market or the value index. Another similar example, Crown Holdings. Very simple business. They make beer cans and soda cans. And because of consolidation in that industry, they too have also been able to grow their earnings quite fast. And it's beer cans and soda cans, so it's not very economically sensitive. And again, we see we were able to purchase this kind of investment at an 11.2 multiple when the market was at 16, in spite of at the bottom seeing a much faster growth rate of this business. There's not a lot of these in the market, as I said. These are the exceptions. We call them the gems. And that's really what we try to do, is find these gems amongst the junk of the value stocks. And so we get all the great benefits that value investing has provided over 60 years, as we've shown you in the earlier charts. And by picking some of the best value stocks, an active manager can hopefully generate even better returns than that. So I went through a lot here, trying to pack a lot into 30 minutes. But let me sum it up for you. The value indices indeed have struggled for over a decade. I believe it's closer to 14 years now. However, value stocks, not the value indices, but value stocks have performed really well. In fact, for 9 years after the financial crisis, they outperformed by about 170 percentage points cumulatively. But it is true, they have lagged for the last couple of years, starting in 2018. That lag is pretty normal within the context of historical value cycles. And we have a lot of optimism to believe that the next value cycle will be one of the best. History shows us that after bad down cycles, we get better up cycles, and valuation spreads are near or at the widest they've ever been. Now, the timing of this is tricky, and that's what makes this hard. When you look at that chart over 60 years, it seems really easy to just hold on and you outperform. And if you did that, if you're able to stick with it, you did outperform. But it's really painful to stick with an underperforming strategy. And as we know, with these cycles, value can underperform for 2 years. Doesn't sound like much, but when you're in the middle of it, as you all know, it feels like a really long time. It looks like value stocks bottomed out on March 18th. And the way these things, it's not because everybody all of a sudden wanted to buy value on March 18th. I think it's because after 2 years of underperformance and then the panic selling around the coronavirus, there was nobody left after March 18th to sell it. That's how these things usually turn. It's not by the entrance of new buyers. It's by the absence of old sellers. At some point, I highlighted Crown Holdings or Quanta. At some point, everybody that dislikes those stocks sells them, and they no longer own them. And once you don't own it, they stop selling it. So it takes this kind of flushing out events to create a bottom. And it appears that we had this on March 18th. Timing is tricky. It's hard to know for sure until well after whether that was really the bottom. But here we are in early September, and it still looks like that was the bottom. And since you can't get value stock performance from a value index, really the only option you have is to go to an active manager. And our particular style is amongst these cheap stocks, which have a great performance history, to look for the gems amongst the junk. And with that, do even better than just buying the cheapest 20%. With that, let me wrap it up and say thank you all for your attention. And everybody stay healthy. Thank you.